Hi, I'm Erik Renander. I'm the portfolio manager for the Hedge Invest Africa Opportunities Fund. I wanted to give you an update on where we are after the first half of the year. The fund is fully invested across the major markets in Africa. We have positions in South Africa, Egypt, Nigeria, and Kenya. The portfolio is about 60% net long and diversified across major sectors as well. Some of our biggest sector positions are in financials, where we have a 13% weight, infrastructure, which includes cement companies and construction companies, where we have a 9% weight. We also have about 9% in telecoms and 9% in technology as well. We also have smaller positions in consumer stocks. The biggest sector position is in Nigerian banks, where we have 10% of the fund invested in the three highest quality, most profitable banks in Nigeria. These are Zenith Bank, GT, and United Bank of Africa. What's attractive about these banks is they're trading on 5 times earnings and benefiting from very high interest rates in Nigeria. There were some concerns about how Nigerian companies would handle the difficulties of the low oil price in the country and whether this would be a big problem for the banks. But so far, credit quality is turning out to be much better than expected, and the bank's profitability is at all-time highs. The banks are trading at 5 times earnings and historically have traded at 8 to 10 times earnings, and we don't think it takes much work for these stocks to go back to trading at 8 to 10 times earnings as they continue to deliver good results. Within the technology space, our biggest position is Naspers, which is a large internet investment company in South Africa with investments in internet companies across the emerging markets. They focus on e-retailing, classifieds, and payment systems in Asia, in the Middle East, in Africa, and India. The company is trading at the highest discount ever to the sum of its parts. And also in IT, we have an investment in the leading IT integration company in South Africa. Technology is growing quickly, and a lot of companies are having a hard time keeping up with new software, new networks, and companies like EOH in South Africa are doing a great job, growing 20% a year, providing network integration, data management, cloud hosting, and selling software to these companies. They're dominant in South Africa, and they're growing across the rest of Africa as well. And then in infrastructure, we have an investment in Dangote Cement, the largest cement company in Africa, and also in El Saweedi, which is a leading construction company for building power networks in Egypt, the Middle East, and Africa. So exciting stuff. Now, when you're investing in Africa, you should be getting above average growth for a below average PE, or a better valuation. And I think we're delivering that. As we look across our portfolio, our companies have, on average, 18% growth for a PE of 10 times and a 5% dividend yield. When we compare this to the major markets of Europe and the US, this looks attractive. If you go to the S&P, you're paying about 18 times earnings for 12% growth and a 2% dividend yield. In Europe, the average PE is 16 times for 12% growth, for 9% growth and a 3.5% dividend yield. So going back to Africa, almost 20% growth for 10 times earnings. I think you're getting very good growth at an attractive valuation. And just interestingly, when you look at our short portfolio, you have about a PE of 18 times for an average 7% growth. So I think the fund is positioned with good growth stocks, good valuations, and lots of upside to our price targets in order to deliver performance. And then one final update I'd like to give is that we're starting to invest in high-yielding local currency African government bonds. So we've invested about 5% of the portfolio into African government bonds. We own positions in Nigeria, Ghana, and Egypt, and on average, these bonds yield 18%. The currencies of these countries have depreciated and are relatively attractive, and the yields are attractive, and there's a chance we can make money on both the currency and yield compression. But in our base case scenario, we'd be happy to just collect the 18% return. I think this is something where we're going to do more work and potentially increase this position in the future. So that's an update. I think we're positioned to make money in the second half, and also deliver below average risk. Thank you.